Good afternoon, everyone, and thanks for being here. I'm Zach, the Outreach Coordinator here at the Taxpayers Help Center, and today we'll look at key tax considerations for stock market investors, including capital gains rules, tax loss harvesting, and the role of tax-advantaged accounts. The Taxpayers Help Center is a nonprofit 501(c)(3) organization in Northridge, California. We operate two tax clinics, the first of which is our low-income taxpayer clinic, where we help taxpayers resolve their tax disputes with the IRS. And the other is our volunteer income tax assistance clinic, where we help prepare income taxes for free. And additionally, we are an IRS authorized certifying acceptance agent for individual taxpayer identification number applications. I, Zach, am the outreach coordinator, and Masood Chertani is the clinic director here at the Taxpayers Help Center. And before we get started, I want to be clear that everything in today's presentation is for informational and educational purposes only. It is not financial, tax, or investment advice, and it may not apply to every individual situation. If you have any questions at any time during the presentation, please email us at info@taxpayershelpcenter.com, and a tax professional will get back to you. The Taxpayers Help Center helps taxpayers both locally and beyond, and since the services we provide are free, donations are important in supporting us and in helping the reach of any services. Any monetary donations are greatly appreciated, and those who can volunteer their time, expertise, or spread awareness are also a great help. If you would like to make a monetary donation, you may do so at taxpayershelpcenter.com/make-a-donation, or if you go to taxpayershelpcenter.com and click on the Make a Donation tab, which I've highlighted here in red, you may do it that way as well. And again, anything is greatly appreciated as these donations allow us to do what we do. So today we'll cover the following topics: how the U.S. income tax system works, the difference between deductions and credits, how stock transactions are taxed, some concepts we'll go over, such as holding periods, account types, and using losses, recent tax changes and common tax myths, and then at the end, we'll go over a case study showing how timing affects taxable gains. So taxes make up a major part of what people pay over their lifetime, often second only to housing costs. This isn't just income tax, it includes payroll taxes, property taxes, and even the sales tax we pay on everyday purchases. Because taxes touch so many parts of life, it helps to have a clear understanding of how they work. Without that understanding, it's easy to pay more than required or make reporting errors that lead to penalties. A basic grasp of the system starts with knowing how tax brackets work, the difference between deductions and credits, and how different types of income, like wages, dividends, and capital gains, are treated. This kind of knowledge makes it easier to read financial documents, understand the tax impacts of certain transactions, and follow the rules correctly, rather. This session is designed to share factual, structured information about the U.S. tax system. While it won't tell anyone what they should do, it will give a clear picture of how taxes work so you can better understand the outcomes of various financial activities. So there are several common errors that commonly occur during tax filing, many of which can lead to paying more than required or facing issues with the IRS. So one of the most frequent mistakes is not claiming deductions or credits that a person is eligible for. Credits directly reduce the amount of tax owed, while deductions reduce taxable income, and missing either can change the final amount due. Another common problem is keeping incomplete or inconsistent records. Accurate record keeping is essential for documenting income, expenses, and other details that appear on a return. This includes maintaining receipts, statements, and documentation for stock transactions. Filing late or submitting return without adequate preparation is another area where problems arise. Late filings can result in penalties and interest charges, and rushing through the process often leads to avoidable mistakes. And lastly, misreporting investment income, especially from stock sales, is a frequent error. This may happen if cost basis or holding period information is incomplete or incorrectly reported. And since the IRS received transaction reports from brokerage firms, Discrepancies can lead to notices or audits. The U.S. income tax system operates on what is called a progressive structure. This means that income is taxed in segments, with each segment falling into a specific tax bracket. Importantly, only the income within each bracket is taxed at that bracket's rate, not all of a person's income. So, let's go over an example. Let's say somebody has $60,000 in taxable income. The first portion of that income would be taxed at the lowest rate, the next portion at the next rate, and so on. Only the final portion of their income, the amount above the prior bracket threshold, would be taxed at the highest rate that applies to them. In the tax system, deductions and credits are two separate tools that affect the final tax calculation, but they operate in different ways. A deduction reduces the amount of income that is subject to tax. For example, if a taxpayer has $60,000 in taxable income and qualifies for a $2,000 deduction, their taxable income would be reduced to $58,000. Common deductions include mortgage interest, certain medical expenses, and charitable contributions. The value of a deduction depends on the taxpayer's marginal tax rate. A $2,000 deduction will have a greater tax impact for someone in a higher bracket than for someone in a lower bracket. Stocks can create taxable events in more than one way, and understanding these triggers is an important part of knowing how investment income is treated for tax purposes. The first way is through the sale of stock for a profit, which is known as a capital gain. Whether this gain is taxed at short-term or long-term rates depends on the length of time the stock was held before it was sold. The holding period, measured in days, begins the day after the stock is purchased and continues through the day it is sold. The second way is through dividends, which are payments made by some companies to their shareholders. Dividends can be classified as qualified or non-qualified, and the classification affects the tax rate applied. Qualified dividends may be taxed at the lower long-term capital gains rate, while non-qualified dividends are taxed at ordinary income rates. In addition to the type of income, the location of the investment, meaning the type of account in which it is held, can influence when taxes are paid. So, for instance, taxable brokerage accounts report income in the year it is received, whereas certain retirement accounts defer taxation until withdrawals are made. When a stock is sold for more than its purchase price, the difference is called a capital gain, and the tax rate applied depends on the holding period. If the stock is held for 1 year or less, the gain is classified as a short-term capital gain. Short-term capital gains are taxed at the same rate as ordinary income, which means they follow the taxpayer's regular income tax bracket. If the stock is held for more than 1 year, the gain is classified as a long-term capital gain. Excuse me. Long-term gains are subject to a separate set of tax rates that are generally lower than um, the ordinary income rates, I should say. For most taxpayers, these long-term rates are 0%, 15%, or 20%, depending on income level, although an additional 3.8% net investment income tax may apply for certain higher income individuals. Stocks can also generate income through dividends. Qualified dividends are taxed at the same rates as long-term capital gains, while non-qualified dividends are taxed at ordinary income rates. Whether a dividend is considered qualified depends on factors such as the type of stock and the length of time it was held before and after the dividend date. In addition to federal taxes, state and local taxes may also apply to both capital gains and dividends, and the rates and rules for these taxes can vary by jurisdiction. There are several recurring concepts that are useful to understand when looking at how stock transactions are taxed. These concepts do not dictate what actions to take, but they explain why the same investment results can lead to different tax outcomes depending on certain factors. The first concept is the holding period, and this determines whether a gain is taxed as a short-term or long-term. The length of time a stock is owned directly affects the rate at which any gain is taxed. Second concept is the type of account in which the stock is held. Stocks in taxable brokerage accounts generate reportable income in the year's dividends are paid or the shares are sold. Stocks in certain tax-deferred accounts, such as traditional IRAs, do not produce taxable income until withdrawals are made. The third concept is the ability to use realized losses to offset gains. If stocks are sold for less than their purchase price, these losses can be applied against gains from other stock sales, and this reduces the total amount of gain that is subject to tax. If total losses exceed gains, a limited amount can be applied against other types of income, with any remaining losses carried forward to future years. Understanding these three topics, or concepts, I should say, provide context for the more detailed discussions that we'll go over in the following slides. So the length of time stock is held before it is sold is referred to as the holding period, and this period directly determines whether any gain from the sale is taxed as short-term or long-term. Short-term capital gains come from stocks, as we've mentioned, held for 1 year or less. And these gains are, of course, as we mentioned, taxed at the ordinary income rate, which means to follow the taxpayer's regular income tax bracket. And long-term gains come from, as we mentioned, stocks hold for more than 1 year. And for many taxpayers, these are 0, 15, or 20%, with that additional 3.8% net investment income tax for certain higher income levels. So to illustrate the difference, consider a $10,000 gain. If it is short term and if the taxpayer is in the 32% bracket, the tax on that gain would be $3,200. If it is long term and taxed at the 15%, the tax would be $1,500. The investment outcome is the same in both cases, but the tax result differs because of the holding period. So this is why the date a stock is purchased and the date it is sold are both important pieces of information for determining how the gain will be taxed. The type of account in which a stock is held plays an important role in determining when income from that stock is taxed. So as we mentioned, in a taxable brokerage account, any gain from selling a stock is generally reported in the year of the sale, or dividends are reported in the year they are paid. This means that investment activity in these accounts can create taxable events on an annual basis. In contrast, tax-deferred accounts such as traditional IRAs do not produce current year taxable events from buying or selling stocks within the account. Gains, dividends, and other income accumulate without being taxed until funds are withdrawn. At the time of withdrawal, the distribution is typically taxed as ordinary income, regardless of whether the funds came from gains or dividends. Certain types of stock investments, such as some index funds and exchange-traded funds, also known as ETFs, tend to generate fewer taxable events than actively managed stock funds. So this is due to lower turnover in the securities they hold, which means fewer sales that could trigger capital gains distributions. When stocks are sold for less than their purchase price, this is referred to as a capital loss. These losses can be used to reduce the amount of capital gains that are subject to tax. If, during the year, total capital losses exceed total capital gains, the excess can be applied against other types of income, such as wages, up to a limit of $3,000 per year for most taxpayers. Any remaining unused losses could be carried forward into the future tax years until they are fully used. This carry forward process allows losses from 1 year to offset gains or income in later years. An important consideration is the wash sale rule. This rule applies if a substantially identical stock is purchased within 30 days before or after the sale that generated the loss. When a wash sale occurs, the loss from the original sale is not allowed, for tax purposes in that year and is instead added to the cost basis of the new purchase. This effectively defers the loss deduction until the replacement stock is sold. While taxes are an important aspect of stock transactions, they are only one factor among many that can influence investment decisions. Stock selection is also guided by considerations such as diversification, which involves holding a range of different investments to reduce exposure to the performance of any single company or sector. Risk tolerance is another key factor. Some investors are comfortable with greater price fluctuations, while others prefer stability. Liquidity needs should also be considered, as some investors may need to access their funds in the short term, while others can keep their capital invested for longer periods. It is also important to note that historical performance is not a guarantee of future results. Past trends can provide context, but they cannot predict the future market behaviors with certainty. Understanding the role of these non-tax considerations provides a more complete picture of how stock investments fit within a broader financial framework. Each year, certain aspects of the tax code are updated to reflect inflation and other policy changes. For the 2025 tax year, there are several adjustments worth noting. First, the standard deduction amounts have been increased. This affects the point at which taxpayers may consider itemizing deductions instead of taking the standard deduction. Higher standard deductions generally reduce taxable income for those who do not itemize. Second, income tax bracket thresholds have been adjusted upward. This means that more income can be earned before moving into a higher tax bracket. The same principle applies to the long-term capital gains income thresholds. The income levels that determine whether gains are taxed at 0%, 15%, or 20% have also been increased. Third, there may be changes to IRS reporting requirements for certain transactions. Brokerage firms already report most stock sales and dividend payments to the IRS, but upcoming rules may expand the scope or detail of what is reported, potentially including additional digital transaction information. These adjustments do not change how the tax system fundamentally works, but they can affect the amounts shown on tax returns and the income levels at which different rates apply. So now let's go over some common tax myths. So here are several misconceptions that are commonly spread about how taxes work and clearing up these misunderstandings. Let's do that so we can help ensure tax information is interpreted correctly. So the first is the belief that income from a side hustle is not taxable. In reality, most forms of income, including earnings from freelance work, part-time jobs, or self-employment, are subject to tax and must be reported. The second is the idea that filing late is acceptable if no tax is owed. Even if the final calculation results in no balance due, failing to file on time can lead to penalties, especially if there was no tax owed during the year that was not paid through withholding or estimated payments. The third is that a large tax refund indicates strong financial performance. A refund simply means more money was withheld or paid and during the year than was necessary. It does not measure income savings or investment success. Another frequent misunderstanding is that stock sales are not taxable if the proceeds are reinvested, unless the transaction occurs within a tax-advantaged account, such as a traditional IRA or a Roth IRA, excuse me. Selling a stock for a gain is generally a taxable event, even if the funds are immediately used to purchase other investments. And finally, there is the belief that all dividends are taxed the same way. Dividends can be classified as qualified or non-qualified, and the classification determines whether they are taxed at the lower long-term capital gains rate or at the higher ordinary income rates. So now let's go over a case study on hypothetical stock sales scenarios. So this is a case study that uses hypothetical numbers to illustrate how the timing of a stock sale and the presence of capital losses can change the way a transaction appears on a tax return. So consider a stock is purchased for $20,000 and later it is sold for $30,000, resulting in a $10,000 gain. In the first scenario, the sale occurs after 8 months. Because the holding period is less than 1 year, the $10,000 gain is classified as a short-term capital gain and taxed at the taxpayer's ordinary income rate. If the ordinary rate is 32%, the tax on this gain would be $3,200. In the second scenario, the same stock is sold after 14 months. The $10,000 gain now qualifies as a long-term capital gain, and if the taxpayer's long-term rate is 15%, the tax owed on the gain would be $1,500. Let's go over a second example. I already mentioned that one a little bit earlier. Let's say a taxpayer loses money. So suppose a taxpayer sold another stock in the same year at a $4,000 loss. In either scenario, the $4,000 loss would offset part of the $10,000 gain, and this would reduce the taxable gain to $6,000. So using the earlier rates, that would reduce the tax from $3,200 to $1,920 in the short-term example, or from $1,500 to $900 in the long term. So these examples kind of demonstrate in purely numerical terms how holding periods and realized losses affect the way income from investments is classified and taxed. So now let's do a little recap. This section reviewed the four key concepts, I guess, that influence how stock transactions are reported and taxed. So first, the holding period. We also talked about the type of account in which the stock is held, and how that affects when income from that stock is taxed. Realized losses from selling stocks at a lower price than their purchase cost could be used to offset gains within limits set by the IRS. And then, of course, just in general, accurate record keeping is essential for reporting these transactions, and records should include purchase and sale dates, cost basis, sale proceeds, and any reinvested dividends. So, with that being said, that's all for today. And again, since our services are provided at no cost, donations are vital for supporting and expanding our efforts. We greatly appreciate monetary contributions, and additionally, if you can volunteer your time, share your expertise, or help spread awareness, your support would be extremely valuable. If you have any questions following the presentation, please email us at info@taxpayershelpcenter.com, and a tax professional will respond to you. So with that being said, thank you all and have a great day.